Good evening and welcome to you all. Thank you for joining us on this webinar this evening where we will be discussing all things personal finance for young professionals such as yourselves. My name is Andy Lebtelezi. I work as an equity analyst at Sentio Capital, and I also form part of the ABSIP Young Professionals Executive Committee. My job this evening is mainly to moderate the discussion that we will be having. Now, this particular webinar is the first of a three-part series that we've entitled a Trailblazers Guide. We will be collaborating as ABSIP Young Professionals with the Standard Bank Group. And the idea is to ensure that these sessions are as interactive and as informative as possible with various topics such as personal finance for tonight, but also just general wealth creation as well as your mental health. So please do look out for the next two webinars after the session and ensure that you register for those. Our focus for this evening, like I said, is personal finance. And to be fair, an hour-long webinar for personal finance is probably not enough, but we'll try to get through as many of the topics that fall under the umbrella of personal finance as possible. Joining us to navigate this conversation this evening, we have two ladies that are well-versed when it comes to this topic. We have Pelisa Siboyana as well as Erica Ferreira. But before we get to introducing them, I'd like to remind you all to please engage with us on our various social media platforms. We are on Twitter, we are on Instagram, we are on LinkedIn as well. Our handles on Instagram and Twitter are at ABSIP_YP. And then on LinkedIn, you can just search for ABSIP Young Professionals and you should find us there. The hashtags for this evening's discussion, hashtags are important, are hashtag ABSIP, hashtag ABSIPYP, hashtag Trailblazers, hashtag Trailblazers Guide. So please ensure that you continually engage with us on our different social media platforms and ensure that you use those hashtags as well. We also invite you to please engage with us using the chat box that you see in front of you, should be on your right-hand side there, or via the Q&A box that is available to you. We will be putting through some of the questions that you have for our guests to them at a later stage in the evening, so please, throughout the session, feel free to ask your questions to our esteemed guests. And then lastly, I just want to talk about how we will also be giving away gifts, giving away prizes. So we will be giving away two prizes, two lucky contestants that managed to answer the questions that we put to them correctly, first of all, but also the fastest. The questions may or may not be based on the specifics of what we discussed this evening, so it would be worth your while to pay attention. Throughout the session, we'll also be running different poll questions. The first one should be popping up on your screen right about now. So please ensure that you continually engage with us using those different platforms. So let's get to introducing our special guest for this evening. First up, we have Pelisa Siboyana. Now, Pelisa is an acquisition manager at Standard Bank. She holds a degree in accounting and finance, and she has 8 years banking experience in private and investment banking. Her experience spans from 5 years at Investec Private Bank and 2 years in the F&B Private Wealth Division. When she's not working, Pelisa enjoys adventure traveling trips, watching movies, as well as reading. Welcome to you, Pelisa, and thank you for joining us this evening.
Thank you. Thank you for having me, Andile, and thank you for that lovely introduction.
You're welcome. Besides her, we also have Erica Ferreira. Erica is an executive financial advisor with Standard Bank Financial Consultancy. She holds a postgraduate diploma in financial planning and an advanced postgraduate diploma in investment planning. She has 6 years of experience in the field, working with professionals from different sectors and industries. And when she's not working, she enjoys traveling, baking, cooking, as well as running. Welcome to you, Erica, and thank you for joining us this evening.
Thank you so much, Andile. Thank you for having me.
All right, now before we get to the crux of this evening's conversation, I think it would be useful to briefly, each of you, describe what it is that you actually do on a daily basis, just to give us a bit of context. Erica, we'll start off with you.
Thank you, Andile. Okay, so in essence, there is 3 main tasks that I go through, throughout the day. So we start off with servicing. So servicing, we look at our existing clients. There's always queries, like on a day-to-day, there's always clients writing in emails, sending in queries. They could be withdrawals, they could be wanting to purchase products and things like that. And then we move on to prospecting. That's where we look at opportunities sent through to me by lead providers. So that's when I then call clients and then make bookings for their appointments. And then I move on to, attending to scheduled meetings for the day with new clients. We focus on comprehensive financial planning. There, I look at risk planning, where we cover life covers. I look at retirement planning for both pre and post-retirement. Estate planning, we look at wills and trusts, and then investment planning, where we look at specific goals. So I always try to touch on all aspects of holistic financial planning to ascertain clients' financial position. So that's basically it in a day in the life of a financial advisor.
Okay, thank you very much. Pelisa, can you do the same, please?
Okay, so my days are quite different on a daily basis. I'm an acquisition manager and also holding a relationship piece, which means that I've got a responsibility to actively grow and enhance in terms of growing the young professional book that we're on. I look after young professionals specifically, and also holding the relationship piece means that I need to actively manage the day-to-day queries, assisting with needs that they have, whether it be investment needs, whether it be financing needs, or just normal day-to-day transactional banking. That's really the space that I fit in. So yeah, so my day is very dynamic, depending very much on my clients' needs, on what they need for the day. But like my core focus definitely is with young professionals, taking care of them, giving them the tools and the expertise that they need in terms of making their financial goals possible. Yeah, that's my day in a nutshell.
Okay, so basically we're talking to the right people here.
Yes, we're
Right.
talking to the right people, the right people in the room.
Excellent. Now, Felisa, let's start off with you here. I mean, we are continually told about the importance of having an effective debt management strategy as young professionals, but I think the concept sometimes can get quite daunting and overwhelming for some young professionals, especially those that have just recently joined the work. So can you maybe start us off with taking us through what exactly an effective debt management strategy looks like, but maybe focus on specific suggestions and practical tools that some of our audience members can take away from tonight?
Okay, so debt management, Andile, is such an important conversation that we need to be having. With the pandemic, what's come in and what's thrown, the wheels off the hinges is really the importance of managing debt. A lot of South Africans, a lot of young people are stuck in debt traps that are seemingly impossible to get out of, right? And so before we even get into the question of managing your debt, we need to ask you, why did you get into the debt? And number two, how did you get into the debt? Because there is certain things that you can get into which are considered as debt but are good debt, like i.e. property and so forth. And then there are certain things like lifestyle debt, which are the problematic ones, if I must say. So when you're talking about debt management and what that looks like for a young professional, it's a very important conversation to be had. I mean, I've just been looking at the stats, and with the whole pandemic and how it's thrown everybody off course, the middle class, which quantifies the majority of South Africans, the working class, the you and I who work every day to try to make a living, those people have increased their unsecured debt by 30 to 40%. And that simply shows you that a lot of the middle class, a lot of the working class people are living to service debt, right? We're working every day to service our lifestyle debt that we've gotten ourselves into. So part of effective debt management is to first and foremost find out, what am I paying? Why am I paying it? Do I need it? And then put a strategy in place and a plan in place to tackle that debt, to how to get out of debt. And there are so many effective strategies that I want to share with the young professionals on the line today of how you can actually do that, how you can do that effectively, and how you can do that in a smart way that won't get you in another cycle of loan upon loan and interest rate upon interest rate. I don't know if I've answered your question entirely.
Yeah, I mean, that's true. And I mean, that point that you made about how much we've increased our debt levels during this time period is also quite interesting. And I think it's something I want to touch on with Erica at a later stage. But Pelisa, to stick with you a little bit here, in as much as we need to be careful about taking on additional debt, we're also constantly reminded of the importance of a good credit score. So how should a young professional think about developing a good credit score without getting themselves into a situation where they're living beyond their means and they find themselves with a little bit too much month at the end of their money, as they say.
Too much month at the end of the month, and I like that. So one of the first things, and I want to go back into getting an effective strategy in place, is to understand your needs as well as your lifestyle needs, right? Understand what you can afford and versus what you want. You know, a lot of times when you talk about the things that we want and the things that we can afford, there is quite a discrepancy there, right? Because I can want a beautiful German car, but the truth is, can I afford it? And that's where the real question lies. You know, when you're thinking about taking on debt as a young professional, you shouldn't only think about what I can qualify for. You really need to consider what can I afford. When you're talking about your affordability, when you're talking about what you qualify for, we basically on your gross income, right? We're looking at your gross income. We're saying an individual of this age earning this amount of money, you know, give or take, can actually afford this amount. But affordability now comes to actually put your expenses into play to say how much can you actually afford. And that's where a lot of young professionals get it wrong, because even when you come to us as banks and you give us your applications, we always understate our living expenses. And you spend 2,000 Rand on entertainment, but you're going to put 200 Rand there, right? You spend 1,000 Rand on data, but you're going to put a little 100 Rand there. And what you're doing is, we can approve you for stuff, but what you're actually doing is shooting yourself in the foot, because when it comes to month end, now you're going to find that you actually don't have enough surplus cash to service your new debt stuff. So number one, Andile, I'll be honest. Be honest. Be honest with yourself. Be honest when you are taking on debt. Is this something you can actually afford with the surplus money that you have at the end of the month? That's number one. And then with regards to your credit score, I always say this to people when I educate people on credit scoring, the importance thereof is that the same way when you have an online profile and people see that, whether it's in social media or wherever, LinkedIn, about who you are as a professional person, your credit score, your credit record is how we as financial institutions see you and regard you, and can actually tell who you are and how you behave with money. So it is of vital importance that we learn how to use credit effectively. And there's so many effective ways of using debt. A lot of people always shy away from credit cards, and I don't want this, I don't want to be in debt. But there's so many great ways to effectively use that debt to build up a good credit score. So in South Africa, the credit score ranges from 0 to 1,000, with 999 being absolutely great and 0 being shocking. So if you are between 500 and I'll say 560, you are the average South African. That's where they predominantly lie. And for a person like you and I to be in the average rate is not a good thing. And I'll tell you why it's not a good thing, because you must remember South Africa is made up of a huge population of people who are actually unemployed, who actually cannot even afford credit due to being blacklisted or whatever. So if you fall under that category, already that's a problem. Already that's a sign for you to start working towards improving that score. There's many effective ways to improve your credit score. There are things like making sure you pay your debt on time. Whatever you have agreed with your lenders to pay, make sure you pay that full amount. Because even if you say you've got a debt, let's say with a clothing store, and you're supposed to be paying 1,000 Rand and you're paying 500, and in your head you think, no, I am making a payment, it's something. The fact that you are not paying the full agreed installment puts you in arrears. And that already sends red flags, red signals to us as financial institutions to say, this person cannot honor their full commitment. This person is a slow payer. Therefore, this person is regarded as a high-risk client. So what I would suggest that you do, if you do find yourself in a position where you are already behind with regards to payments because you can't meet the full obligation amount, go back and renegotiate that installment. As long as it's something that you pay the full amount agreed, then your credit score really becomes, it picks up. And also, guys, if you've been blacklisted, you're a young person, maybe you took up debt, you had student loans, and all of our life circumstances are different, I would definitely suggest that you stop taking new credit. I know sometimes it seems like it's the natural thing to do because you need more money, but try to maximize on the current money that you do have. Don't take on new debt. Avoid microloans, things like Wonga loans and payday loans, all those short-term debt and 32-day loans, those small loans. They really, really increase your risk status because they show lenders that you can't be trusted for a long duration of time, only a short term, and even in that short term, you are a high risk person. So try to avoid those temp loans if you can. That will really help your credit score. Something else that will really help your credit score, you actually can get a free credit report. And I say this to all of my clients to say, pull up your credit report, see what is on your name. You'll be surprised the things that you'll find on your name that you didn't even know were there. I, for example, found an Avon account. I've never had an Avon product in my life. So now I had to pay that because it's reflecting negatively on my name. If I did not know or see that, I wouldn't have known. And I'll just be declined for everything without actually knowing why, right? So get familiar with your credit report. It's your status online. It's like your Instagram, Facebook picture, whatever. It actually is what it is that's going to give you access to financing and make you credible to lenders in terms of who you are. So get familiar with it. Know what you're paying. How much is the interest rate? Be familiar with the stuff that you've taken. Don't just take it for granted that, my name is bad or whatever. That has a very big ripple effect on you. Also, as a young professional, your credit score can actually limit you from getting certain jobs and employment in certain sectors. So it's of utmost importance that you are aware of what it is, you know how to handle it. Most importantly, if it is in a bad state, you know how to work effectively to improve it.
Okay, look, there's a lot to take out of everything that you've just said now, and I hope everyone out there is listening. Remember to be honest about yourself, about how much debt you can take on, and also remember to be honest when you're telling the banks about your monthly expenses. Erica, to bring you in here, Pelisa did touch on the fact that she's seen an increase in debt levels over the last, call it, 12 to 18 months. And a large part of the reason for that could be attributed to the fact that central banks all over the world, including ourselves, of course, have aggressively cut interest rates over the last few months, just in an attempt to try and support the economy, of course. Now, a lot of clients will have taken this opportunity to take on additional debt because all of a sudden repayments are affordable. Can you maybe touch on some of the conversations you've been having with clients to try and help them avoid making the mistake of getting themselves into too much debt when interest rates are low? Because at the end of the day, we all know that interest rates are likely to start rising again. So it's not a matter of if, but when. So how do you help clients protect themselves from making mistakes that are going to see them in an untenable position when interest rates start to rise again?
Thank you, Angela. So in my space, if a client comes and is taking a short-term loan, then I would definitely advise them to try and cover that in a short period of time so that they can take advantage of the low interest rates. But if it's a long-term type of loan, then they run a risk of not being able to afford it when in the long run, say when the interest rates stabilizes and they go back to where they were. So there is two options really. I know that this is more on Pelisa's side. So a client can negotiate a fixed rate with the bank. So you pay the same repayment amount monthly for an initial agreed time. So regardless of fluctuations in the market, you can still factor that into your budget accurately to say this is a fixed rate, even though it's going to expire at some point, depending on the term that you would have negotiated with the bank. The only hiccup there is that the bank may charge you a higher rate, right? So it's fixed. So for them to cushion themselves as well, they may charge you a higher rate. And then the next thing is a variable interest. So this is the one that fluctuates. So the current prime rate is at about 7.25. And then before the pandemic, I think it was at about 10.25. So I would encourage our clients to try and peg it when you do your budget, instead of using the 7.25 because that's short-lived. So you may want to go a little bit higher to maybe 10.25 where it was before the pandemic, plus 2 when you do your budget, because banks will always lend at prime rate plus 2. So if you do that, when the interest rates go up, then you're not in a shock because already you have overestimated, the interest rate. So I think that will at least try and cushion, the gap between the low interest rates and when they go up. So I know that's more on the retail side, on Pelisa side, but when they come to me, that's what I would suggest to say. If it's short term, try and reduce it as soon as possible before the interest rates go up. I don't think, from the news, I don't think the interest rates will go up in the next couple of months, maybe next year. But if it's short term, try and cover that as soon as possible. If it's long term, try and then overestimate the interest rate rather than to go 7.25, because when it stabilizes, you might find yourself, in a space where you are not able to afford to pay off your debt.
Yeah, exactly. Okay, no, that makes sense. But you mentioned budgeting there, Erica. So to stick with you, I think obviously everyone on the call will be familiar with the concept of budgeting, but some will have specific questions about the process. So for instance, how do I know what the optimal percentage to allocate to different categories in my budget are? So for instance, I'd like to invest my money. I'd like to contribute to my retirement. I'd like a nice car, a nice house, but equally as important for my sanity and for my well-being, I want to be able to buy a nice pair of sneakers whenever I want to, or go out to eat with my friends whenever I want to. So, I mean, with that in mind, how do I know that I'm investing enough for my?
Yeah, that's a very good point, especially for young professionals. So there is a popular 50-30-20 rule. I don't know if you're aware of that. So it's a popular budgeting rule where 20% of your income goes to your savings, 50% goes to your essentials, and then 30% goes to your discretionary spending. All right. So if you try to stick to that, then you may be definite. So in my space, there is a financial planning exercise that we conduct with all our clients. It's called the financial needs analysis. So this one determines the current state of your finances and also your future financial needs. So what it does is that it always gives us a shortfall to say that, like you mentioned, you are, contributing to a retirement annuity, you're saving towards your retirement. You're probably still, contributing to your pension, your employer pension or provident fund. You also have an RA. But what we do now with the financial needs analysis, we then determine to say, so Andile, you want to retire at age 60, right? And how much do you want to have at retirement? So we also calculate your life expectancy. So, from the top of my head, we work with 90. So you want to retire at age 60. You have 30 years to age 90 that you are not bringing any income. So those 30 years, you need to start saving for those now. So you tell me, Erica, I want 20,000 per month from age 60 to age 90. So now we'll calculate to say, all right, so this is how much you're paying in present value. In future value, this is how much you're going to have. So what is this discrepancy? What is the shortfall here? So when we do that, it will also aid to your budget to say, okay, when we did the financial needs analysis, there was a shortfall that came up. So how do we mitigate that shortfall? Right. So we also aid to the budget to say, okay, so maybe we need to increase on the retirement planning, or maybe, like you said, you have a goal, you want to buy a car. How much is it going to cost? How much now do we need to put in place? So this exercise actually helps, and it goes hand in hand with the budget to say, since we're looking at 50-30-20 rule, so how then do I split my 20? So the 20 is the one that you're going to use now for your savings and investments and all those things. So it actually works like that. So I think the 50-30-20 rule really works well in defining how your budget is going to look.
Okay. You mentioned me wanting 20,000 Rand a month. I think the number's a bit closer to R1 million a month, but that's another story.
If you tell me you want R1 million, Andile, I'll give you a shortfall that will shock you. remember when you're speaking about retirement, age 60, you don't have debt. So you've cleared all your debt. Your major expenses are probably your medical aid, food, and maybe rates and taxes. So you're not paying for a bond. If you have had kids, they are not depending on you financially anymore. So what would you need R1 million for per month? So that's what we work with to say present value. Say you're 60 now, your children are independent, and you've paid off all your debts. How much do you think you're going to live on in today's value? So you told me maybe you've downsized, you don't have a big house anymore, you're probably in a retirement home somewhere. you need maybe 15 to 20,000. So that's generally what we work with to say, okay, so at age 60, in today's value, obviously the system will calculate the future value. You want to receive 20,000, how much now do you need to save? Right. So that exercise is actually vital. It's actually the backbone of the financial planning, as a whole.
No, I get you. And I mean, speaking of tools, are there any easy to use tools out there, budgeting tools that you would suggest some of our audience members look into that would help them?
So Excel always works better for me. It's very basic and traditional, but I see that there are more on Play Store, especially if you are on Android. You go to Play Store, there are a few that are free there, but for me, Excel always works better.
Okay.
Yeah.
There should probably be a poll popping up asking you guys what tools you use for budgeting purposes. So please do engage with that. Erica, to stick with you here, over the last few months, we've seen the emergence of the importance of having risk products as part of your budgeting process, whether it be medical insurance, life insurance, income protection plans, rare disease cover, etc. In terms of speaking to young professionals, I mean, what would you say to try and emphasize the importance of having such products as part of your budgeting process, rather, because a lot of them will tell you that they don't have any dependents, so why they need any risk? I mean, how would you talk about the importance of having such?
Okay, so if we go back to when I spoke about the day in the life of a financial advisor, I spoke about risk planning as well. When you talk of risk planning, that's when we're speaking of life covers, disease cover, income protector, disability, and things like that. So in terms of income protector, it is actually designed to give you the reassurance that your income will be covered. So it provides you with that monthly payments should you be temporarily or permanently unable to do your job through maybe disability, or maybe you've suffered the permanent impairment. So it then replaces your income. So a lot of employers will probably give you your full salary for a month. Some will give you for 3 months. Then after that, they cut it. So they probably cut it by 25%, some even by 50%. So when you have an income protector, that's when now it kicks in. It replaces, your income, because now you're not able to work. So this also has an addition to it. So an illness or a disability may not be the only reason why you're unable to earn an income. So now it also includes a child illness protector. Should your child be terminally ill and you need to care for them, obviously you're not going to be at work. So also the income protector kicks in. All right. And then you mentioned a good point to say, and I hear that a lot with young professionals. When we conduct our comprehensive plan, they say, I don't need a life cover now. Like, I don't have any dependents. I'm still young, But it's very important to look at risk planning and life cover. So if you are adamant that, no, I do not want risk cover for now, there is an option. There is future cover. So future cover, it is a policy protection benefit, which then lets you purchase an additional risk. So if you have an existing one, or at inception, if you don't have, so you can actually purchase a risk product in advance. Right, so it covers you in advance. Why do we do that? Because now, remember, when you grow older, that's when now you have more diseases, and it might actually be more expensive to then take cover when you now have acquired one of those bad diseases. So it's always good when you're still young, you purchase a future cover. It will cover you for future, even though you feel you don't want it now. So it actually comes a bit cheaper, and it also has an expiry date. Right. So the only medical underwriting that you need to go for when you want to purchase a future cover is HIV test. You just need to have a negative HIV test. All right. So apart from health, something that we need to look at, your age is also one of the primary factors that influence your premium. So your premium rate is influenced by your health and your age. So on average, premium amount increases by about 8 to 10% every year. So it can go as low as 5% annually if you are below 40 years. It can also go as high as 12% if you're above 50. So age also determines whether you can actually qualify for a life cover. Okay, so also given that the qualifying medical exams are getting increasingly stringent, so it actually costs more to get cover when you are older. So it's actually quite advisable for young professionals, even though you don't have dependents now. Good to get future cover. It will help you, when you then get older and you're then, when insurance companies then come back to you and say, we are not insurable, maybe because of diseases and things like that. In terms of disability, so I always say the younger people are more at risk of getting disabled than the older ones because they are full of life. They go out, they have fun, they do all sorts of things. And before you know it, you're in an accident. What happens? Now you're disabled and you're not covered. So then what happens then? So actually the young professionals and the younger clients, they are more at risk for disability. So you always need to have that disability cover. Talking about dread disease, nobody's immune to cancer. Nobody's immune to heart attack. So actually, if we look at statistics, it says that 30% of deaths in South Africa are caused by cancer. And these are not old people. We have seen young people being diagnosed with these ugly diseases. So it's almost always important. Actually, if you take a life cover and you don't take dread disease, you are doing a disservice to yourself. You always need to cover yourself against these terrible diseases. So yeah, it's important for young professionals to take risk cover and to actually look at risk planning holistically, not just to say death, but there is other things that are involved in risk planning.
Okay.
Yeah.
Thanks.
So Andile, if I can just come in there, please.
Of course.
To Erica's point, I think last year in 2020, when COVID really started and we're all sort of in the shock of what is actually going on with this global pandemic. I mean, I've never seen so many people die that I knew personally. I've never seen so many of my clients come, literally in tears because they could no longer afford their bonds or, the investments that they had. They had to surrender some of them because they could no longer afford to have what they usually had as just, as a way of life. So young people, we always make the mistake of thinking we have more time. We still have time to get dread disease cover, to get life cover. I still have time, to get funeral policies for my parents. I mean, they're not going anywhere anyway, but you actually don't know, guys. And, COVID has shown us the reality of how short life is. And so I would just really want to urge everybody on the call to really start considering these things. At Standard Bank, we offer all this information to our young professionals for absolutely free. Erica has an array of things that, she can further unpack to you as an individual on the call. And we have it available for you. And these are things that we need to really start thinking about. Also in the case of disability, that's a very shocking thing that as young people, we're going out, we're in cars, we're doing things on weekends, and it's a reality that you could get into a life-altering situation in a matter of seconds. So these are the things that we really need to start thinking about, start actioning, and not just saying, oh, I'll do it when the time comes. The time is now, guys. The time really is now. We have the expertise, we have the speciality, and we really want to share it with people. And that's why this webinar is so important to us, because we really want to show young people that it's not just for our parents or our grandparents to have these things in place. We need it. The earlier you invest in having good policies, good covers, good financial banking, the better it is for you. The earlier invested you are, from an investment perspective, the higher your returns that you reap. So yeah, it's so important. It really is important. I've seen it firsthand with a lot of people, a lot of entrepreneurs whose businesses went down last year. And if they didn't have, income protectors and that type of thing, they wouldn't have been able to provide for their families. So it's of utmost important what we're discussing tonight.
Okay, and I hope everyone takes that message on board. Phyllis, to stick with you here, another interesting topic is obviously asset-backed financing. And I mean, just from your experience, what are some of the do's and don'ts of asset-backed financing?
Okay, all right. Let me start with the most popular one for young people, which is cars, right? It's an interesting one. I've got a friend who's an F&I at one of the dealerships. See, they work for Hyundai and Kia, which will look where you would look for young people more the entry level cars, your i20s, your i10s. Those are the cars that you would usually see maybe like your interns driving, or first job kind of people driving. You'll be surprised. What he told me is they've never sold so many cars to middle class and even higher grade manager, senior manager people. Why? Because people are downsizing. People are, downgrading their lifestyles to accommodate the changes in their lives and getting cheaper cars. So when talking about asset-based financing, we're talking about going to a financial institution, approaching a bank or whoever to get financing to purchase an asset, right? And so that's what's happening right now. What we're seeing is more people are returning higher end cars to get cheaper cars because life has become more expensive, obviously with medical bills and everything else piling up, and also just the uncertainty in the economic environment. It is safer for you to have more money that's lying around than not to, right? So a lot of young people right now, interestingly enough, are also getting into asset-based financing because some people whose jobs were not cut, their salaries were not cut, have more money to play around with. And so they're thinking, a new car. So what I would definitely want to say to young people and young professionals, most importantly, is when you're purchasing an asset, consider all sides of the coin. Okay, consider all sides of the coin because it's very good and well for you to have a beautiful German car. But again, can you afford it? Are you keeping up with the Jones? And most importantly, is that a necessity or is that just a want that you have? Because one thing about a car or a new place that you've just bought, you can't just take it back and it's that simple. There are so many consequences that come with you having debt written off, with you being blacklisted, with a car or the house being repossessed. It's such a reality that you can't afford to just make an impulsive decision about it, right? And so also when you're considering to purchase an asset using financing, consider the interest rates. We've spoken quite extensively about interest rates, about how they move, about what we're expecting them to do. But consider interest rates that you're getting. At Standard Bank Young Professionals, we actually give young professionals up to prime -1 for new vehicles, up to prime -1 for new houses. So when you're thinking about, okay, I'm actually thinking of getting my own place now, we actually assist you with 100% financing where you wouldn't even have to put out a deposit or anything like that. Those are important things to consider when you want to make those big ticket items. I hear a lot about this in the market where people say it's a buyer's market. Get a house, it's a buyer's market. And all good and well it is because interest rates are very low right now, which makes it cheaper for you to buy a nice apartment, a nice house for your mom, for yourself, or whatever. But also, again, guys, consider all sides of the coin, right? Because you're going to be buying a new apartment and you've calculated the interest rate. You're going to be paying, let's say, 6,000 Rand a month for that. But you have not considered the rates, the levies, the affluent, wherever you're going to be staying. So there's so many sides to asset-based financing that you must consider before you commit. But definitely, if you have the capacity, if you have a good financial institution that's backing you, go for it. Go for it. It definitely is a buyer's market. If you want to get a nice car, if you want to get a nice house, make sure it is in line with your goals, number one. Number two, it is in line with your affordability. It's something that you need for yourself and not because you want to keep up with the Joneses. And most importantly, you know that after paying these expenses and any other associated costs with this asset finance that you're going to go into, you will still have money to live by. Also with the car, just on the notion of associated costs, I speak to a lot of young people who want to apply for cars and they want advice on that. On, Pelisa, how do I go about this? I really want this BM, it's so beautiful. And the question is, did you consider the insurance on that? Did you consider the petrol on that? Did you consider the maintenance on that if you are buying, say, a second-hand car? And other people say, okay, let me get a personal loan for 100,000 from Bank X and I'll go buy myself a Polo and, it's cash, at least it's mine, I own it, I'll just have this personal loan that I'm paying off, good and well. But also buying a second-hand or an older car has its own burdens and responsibilities that you need to be ready for. So there's many things that you need to consider before making a decision like that. because you are young, you don't want to get yourself into a trap that you can't get out of. And like I said, the consequence of repossession of a house or a car is far greater than, just wanting it and buying it because you can.
Not too sure if we've lost the feed from our guests there. Can you still hear me, Pelisa and Erica?
I can hear you, yes.
Okay, perfect. Thanks. I think all of that, we need to take all of that into consideration. Key message there being, don't be afraid to downsize if things get tough. Don't feel the pressure to keep up with what you're seeing on the gram, because at the end of the day, when it's you and your finances, the guys on the gram are not there to help you out. I'm gonna pause. I'm gonna pause there to see if we have any questions on the chat and in the Q&A box. Just like to remind everyone, if you have any questions to post to our guests this evening, please feel free to post them in that chat or in the Q&A box. I'm gonna start off with a question from Akona Miendeki. Akona asks, what active strategies do banks offer in the instance that a young professional might find themselves in debt and are affected by pandemics like coronavirus or retrenchment? I think whoever feels comfortable taking that one can take it on.
Okay, I'll take it first. I'll just talk on what we did last year as a start and then what we're currently doing now. So you'll remember last year when the pandemic started and there was a lot of uncertainty in the market in terms of what would happen to people's jobs, salaries, etc. Standard Bank was actually the first bank that came to the party to say, we are going to offer 3-month payment holiday to all of our clients who have been affected adversely, and their income has either been reduced or cut completely, right? And so what we do there, Akona, is we actually sit down with the client. It is very case by case specific because each person's circumstance is different, right? So we look at the client's expenditure, we look at the gaps where we can help, where we can actually solution. So we started off with 3-month payment holidays, which was an outright, relief for you to say for 3 months, at least you don't have the burden of repayment on your car, on your loans or whatever. And then subsequently after that, which is where we are now this year, we look at it on a case by case basis. We don't want, the last thing we want to do as any bank is to repossess people's cars, houses. That's their homes, that's their achievements. And it is our responsibility to make sure that our clients keep their assets. So what we do is we work with the clients hand in hand to make sure that they can still fulfill their duties in the level that they are in, right? So we definitely have a lot of different ways that we do this, but it is very case by case specific. Like I said, person X maybe has so much more debt than person Y, so we deal with them on a different cases. But what I would advise anyone who is feeling pressure from their finances, get in touch with your bank. Get in touch with somebody who can help you with some sort of a consolidation loan, payment holiday, a reduced repayment, a restructure of your loan to see where we can actually assist you. Banks are there to help, guys. Banks are there to facilitate, you being able to get out of whatever financial circumstance that you're in. So don't be shy and wait until things go red before you actually seek out for help. So that's what I would say from my end.
Okay, thank you. I think, that pretty much covers quite a bit. Hopefully, Akona heard that message loud and clear. The next question we have is from Uma, who asks, how do you choose between retirement annuity, a provident fund, and a pension fund? Or should we be splitting among all three? Erica, maybe you can come in here.
Yeah, thank you. So in terms of splitting between those two, I would like to just mention that with a pension and a provident fund, you can't take it as an individual. So that's part of a package that comes with your employment. The only thing you can take as an individual is the retirement annuity. All right. So I don't know if I've answered that. So the question is, how do you split?
Yeah, her question was about how do you split. So yeah. I think oftentimes your employer will probably dictate to you what it is that you put your money into, whether it be a provident or a pension fund. And then if your employer doesn't have access to that or they don't offer that, then individuals are more inclined to take retirement annuities. So I think that pretty much covers what Uma was asking about there.
Yeah, maybe just to add on to that.
Okay.
Also to say that, so it just goes back to what I was talking about in terms of your shortfalls. So if your employer is not giving a pension or a provident fund, so now it means you're starting on zero. So now we calculate to see when you retire, how much do you need? So then we'll then be able to see what is it that we need to allocate to a retirement annuity.
Okay. Thank you. Next question is from Neo. Neo asks, she's asking about wills here. So she asks, how often should one be updating their will? National Wills Week is in September. Will the Standard Bank Group be offering free drafting of wills by any chance?
So we are actually running a free wills campaign this month. And the reviews of wills should be done annually, or isn't when you have had a change in your life. So something has happened. I'll give you an example. Maybe there's an addition to the family. You're getting married, getting divorced. We need to look at the will and to make changes so that we keep aligning. So every time there is a change in your life, you need to then look at your will. But other than that, it's normally recommended to be looked at annually. But we are running a free wills month for the month of September.
Okay.
Yeah, and just speaking about wills, sorry, Anile, just speaking about wills, if you are married and you divorce and you do not update your will within 3 months of that divorce, your ex-spouse can still claim on your estate. So if you are getting divorced, make sure that you change your will ASAP. It's so important. Otherwise, your ex can still come back and be like, I'm still on that will, and they actually have a claim.
I hope our audience got that message loud and clear as well. Look, next question is from Avile. Avile asks, he says, hi there. What is the best way to save up for a car? Save monthly or invest your savings aggressively? He actually makes examples of Bitcoin, equities, and aggressive unit trust. So maybe we can broaden the question a bit by discussing some of the more appropriate savings or investment vehicles that young professionals should consider for different reasons.
Okay, can I just please start with the reference of the car? Because I think it's such a relevant one in terms of trying to put down a deposit, right? If you are of the view that, let's say your car costs 300,000 and you want to put down at least 100,000 so that you finance only 200,000, which will obviously decrease your monthly repayments, right? So there's two things to do, okay? So there's one way you can follow by saying, okay, if I want this car and I want to only finance 200,000, and let's say the calculations has been done and you are told that you're going to be paying 3,000 rand per month for this car. So what are the smart ways to actually test yourself, to test if you can afford this new purchase, is to start putting away 3,000 rand every month. And where you put it is not the question right now, right? It's just to test your affordability, your capability to put away this money and to actually own this new car. So you start putting away 3,000 rand, you start saving it either in a 32-day notice account, wherever, because the goal here is not the interest or the return part, but really to see the surplus affordability part. You put it away for 12 months. If you can successfully put that money away without any pressure on your finances, then you know you can afford it. And also, you've also built up a nice deposit for yourself to go and purchase that car. So that's first prize, because you've tested to say, in my living conditions, can I actually afford to add this new responsibility of a car? And then secondly, if you want to put your money away in an aggressive savings tool, my go-to place is definitely unit trusts, right? Because obviously, if you're putting away money in a normal savings account, good and well, you will get a return, but you must also consider that interest rates have dropped significantly since the cuts in the interest rates by the Reserve Bank. So when you put your money away in a unit trust, you're putting it away in an aggressive investment vehicle, and unit trusts obviously vary from 1 year, 3 year, 5 year, and 7 years in terms of the time that you can be invested. So if you give yourself by proper planning with Erica and you say, you know what, I actually want to buy a C class in the next 2 years. Okay, so you know you've given yourself 2 years. There are correct funds that you can get into for 2 years that you can invest your money in on a monthly basis, and they aggressively, buy units for you in the market, and you get a return. And that also comes with tax-free unit trusts, which we do offer as well at Standard Bank with different kinds of, savings accounts and underlying assets, I beg your pardon, that you can actually add on there to make your fund more aggressive. So you've got this unit trust, that's my go-to, where you can actually get a big return out. Plus, that return is completely tax-free. So those are some of the things that you can get into. Things like Bitcoin and easy equities and all those other stuff. I would say get more information about it. Be more knowledgeable before you take the plunge, and maybe invest your money with the Forex guy from Facebook and all the other stuff. I would say get as much information as you can on those certain things. Because there is a level of risk to it, of course, but also come to the bank. The banks are open for business. They do have very safe and lucrative investments that you can actually get into and get a good return.
Okay, comprehensive answer there. Thank you. We do have about 10 minutes left in the session, and I did mention the fact that we will be running a competition when we started the session. So I think it's time that we got to that. So hopefully you guys have been listening. Like I said, the question may or may not be based on what we've been discussing this evening. We're going to flip it a little bit, though. We're going to borrow the concept from another entity that runs a competition this way, and we're going to give you the answers of the 2 questions that I'm going to ask you. So then your task will be to articulate what the question is, what the appropriate question to this answer is. Now, answer number 1 is 36,000 Rand per annum. 36,000 Rand per annum. What is the question? Answer number 2 is when you retire, when you resign, and when you are retrenched. What is the question? I'll repeat that again. The answer is when you retire, when you resign, and when you are retrenched. What is the question? So the quickest 2 people to answer those questions correctly will be awarded with the prize. And while we wait for that to happen, I just want to bring it back to both of you. Obviously, you ladies are now well versed with the concept of personal finance, but for you to get to this stage, you'll have had to experience some growing pains. I'm interested to find out if any of you have made personal finance related mistakes in your past, and what are some of the key lessons that Erica, will start off with you.
Yeah, thank you. I've actually made mistakes with personal finance, planning, especially when it comes to budgeting. So it started with not tracking my budget, which actually led to overspending and impulse buying, right? So that lack of, an accurate record of past spending also landed me in hot soup, where by the end of the month you're left on zero because you have, spent more than you earn. So also spending before saving is also one of those mistakes that I used to make, to say I spend a lot and then I'm not saving anything at all. So with proper budgeting and also using that 50-30-20 rule that we spoke about initially, has actually helped me to, try and stay on track and to budget accurately. So the major mistake is overspending and impulse buying.
I
don't think you're alone there. But thank you for that. Pelisa, what about you?
Ooh. Okay, let me take it all the way back to my first job, right? So when I first started working, my first mistake was taking debt that I was offered that I didn't actually need. I won't name the name of the bank, okay? But I went to a particular bank and they offered me 20,000 Rand. I was so young, okay? And I just took it. And I don't even know what I bought with it, Andile, but they said you qualify for 20,000 Rand. And I think it was like my 3rd or 4th pay slip that I had got. And I took it, right? And I blew that money, obviously. And then after that, I started just taking a cell phone account. I took an account with Edgar's. And then it just started to grow. And then I started taking a credit card and then another credit card. And a lot of it was lifestyle debt because I didn't really, it's not like I was buying cars or furniture or something substantial. It was really lifestyle debt because I was not I did not have the correct financial education and, understanding of what this all actually means. I just knew I've got a plastic that I can swipe. And that landed me in hot water because now I've overexposed myself. And now I needed more debt to just get by. And now guess what happens? You take on something we call a consolidation loan to say, okay, this person said, let me give you a loan that will cover everything you pay off one loan. Sounds like a great idea, but the interest rate that they got me into was so high. I think I was paying close to 25.5% in interest with that particular organization that I will not mention. And that was extremely high. You know what I'm saying? So it took me a long time. Now I've got this big, huge loan that I'm trying to pay off that paid off the other smaller ones. And it was just so unnecessary. And I really, really learned my lesson. And that's where I think I picked up the importance of understanding what interest rates mean. Because just because you apply for something and they say you're approved, without actually checking how much you're paying back from an interest perspective is very, very dangerous. So I learned that as a hard lesson. And I learned another hard lesson of not paying your stuff on time. When they ask you, do you want to set a debit order? And you're like, no, I'll just go to the store and pay. That's a very it's risky. And that's where I also got in trouble from a credit score perspective because I wouldn't pay on time. Let's say it's a Saturday or it's in a weekday and I'm at work or whatever. And just the fact that I missed the date I said I was going to pay on already makes you a slow payer. So I learned that lesson the hard way. Always put debit orders in place. So yeah, I think those are my lessons. I am in the green now, guys. I have paid out everything. And yeah, that's why I'm so passionate about this kind of thing.
Amazing stories. Thank you very much. I mean, I think we can all learn some lessons from those mistakes. The one other thing that would be nice, I think, for the audience gathering with us tonight is for you guys to recommend any personal finance related resources that you find quite useful for our young professionals to look at, whether it be podcasts, books, YouTube channels, etc. Erica, we'll start off with you.
Okay, Andile, there is a book that I read. It's called The Anticipatory Organization. It's by Daniel Barros. It's really a good read. It speaks about the organization in different aspects. So actually an organization can be an individual. So this book, it helps in adapting to trends, and also financial planning is key because it guides us to know what is critical for our clients so that, they remain afloat. So it is really a good read. If anyone can get hold of it, it's called The Anticipatory Organization and it's by Daniel Barros.
Okay, thank you. We'll look out for that. Felisa, what about you?
From my side, I'm very much an articles kind of a person, so I really do enjoy the FinMag, where you can find different articles on different things, and you can read what's topical, what's not. So I watch a lot of that. I read a lot of that. And also News 24 for me is actually a very credible source of information. I look at that on a daily basis. I also do check Bloomberg on a daily basis just to check where, certain shares are moving, because we do a lot of advisory on that for young people in terms of getting into shares. So those are some of the things that I look at on a daily basis. From a podcast perspective, there are excellent podcasts out there, guys, that you can listen to while you're driving to work, while you are busy exercising, on financial wellness, especially also on personal effectiveness. I think if you are an effective human being, all other areas of your life do also get that ripple effect, including your finances. So just that constant improvement on yourself will also, ripple effect into your finances, 100%.
Okay, we'll take note of those as well. So thank you very much for those recommendations. We have reached the tail end of our session this evening. I really hope that all our audience members thoroughly enjoyed that and really did walk away with practical things that they can start to immediately implement in their day-to-day lives. Just a reminder that this is the first part of a 3-part series in which we'll be collaborating with the Standard Bank Group. So make sure to check out the next 2 sessions. Make sure you register in time and make sure you attend the webinar. I would definitely like to thank our 2 ladies for joining us this evening and sharing so many gems with us. So thank you very much to Pelisa. Thank you very much to Erica. We will be sending you a small token of our appreciation at some stage. So thank you very much for joining us. I don't know if you have any parting words that you'd like to leave our audience with.
Okay, I can go first.
Do you have any? Oh, sorry, Erica.
I can go first, Andile.
Sure. Please take it away.
Okay. So my parting remarks, I would say in your life journey, you always need to have a financial advisor by your side. So when you start a new job, when you resign, get retrenched, married, children, divorce, right through to post-retirement, you always need to have a financial advisor. And also a solid, comprehensive financial plan will help you achieve your financial goals. So I cannot overemphasize the need of always having that, financial advisor buddy by your side, or all the, everything that you do in your life. I can give you an example. I remember one of the roadshows that I attended. There was a speaker who was also a financial advisor, CFP, has a small book of clients. And one thing that caught my attention is that she mentioned that one of her clients wanted to purchase a truck. But before they could do that, they had to call her first. This is what we're planning to do. Can you come and see if it's actually aligning with our goals? So, like I said, I can't overemphasize the need to have a financial advisor in your life journey. Thank you so much.
Thank you very much. Pelisa, can I ask that you, in 30 seconds, leave us with some parting words for our audience?
In 30 seconds, your financial destiny is in your own hands. Your life is in your own hands. Don't make a mistake of thinking that it is dependent on somebody else to get you where you need to get to. You are responsible for you. That's all.
Thank you. Straight to the point. Thank you very much to both of you. Thank you very much for the messages. I am told that the two winners of our competition are, drum roll, Njabulo Nwabe as well as Aviwe Mahanjana. Congratulations to you both. You got the correct answers in the quickest amount of time. Please do email us your email addresses, send your email address to us, or contact us on our Instagram or Twitter pages. As mentioned before, our handles are at ABSIP_YP. We will also announce our winners on our social media pages, of course. So thank you very much for participating. And then thank you to the entire audience for joining us this evening. I hope, like I said before, I hope you found it as useful as we try to make it to you, and that you can really walk away with practical ideas that you can immediately implement in your life. Thank you to Bhavini, Sia, and Michael as well for doing all the hard work behind the scenes. And please also remember to take part in this post-event survey that we will be putting out. Hope you enjoyed that. Thank you very much again. Enjoy the rest of your evening. Cheers.
Thank you. Thank you, guys. Bye.
Bye.
Bye-bye. Bye.